Will Woodall. I'm joined as usual by Mike Rarey, and we're going to talk to you about forecasting prices and how we think about prices and their relative points over different durations. All right, so take us through what we're looking at here, Mike.
Yeah, so this is a chart that everybody's seen. This is just the S&P 500 index price since 1990. And if this is your starting point in terms of predicting what the future price of the S&P 500 is going to be, it's really not helpful at all.
Right.
In fact, it's absolutely useless. And we've been taught this throughout college. But the good news is there are a few relatively simple statistical methods we can apply to a simple price chart that can turn the same data into something that's extremely effective at predicting future prices. Mm-hmm. And this is the basis of our long-term price forecasting framework. Right. How do we predict returns for U.S. large cap stocks over the next 10 years? Well, we're about to talk about how we do that, and it actually works very well.
Yeah. So let's throw that one up here.
Yeah.
So explain trends and how they're calculated and what they mean over different durations.
Yeah. So all we've done, this is the exact same chart we were just looking at. That's not very helpful. And we've done two things to it. One is we put it on a log scale. Once again, a statistical thing that basically what it does is it takes an exponential growth pattern, which is what we were looking at, and it turns it into a linear pattern, something that our brains are actually much more comfortable working with. Right. From an evolutionary perspective, linear trends are much easier to conceptualize than exponential trends. And so you can see it flattens out quite a bit. The blue line flattens out. And what it also allows you to do is create a trend line, which is that gray line. And the slope of that trend line is what you call the return trend. So how much is it going up over time? And it's 6.6% annualized. Mm-hmm. That's very useful information. And this is just price returns. This is before dividends. Okay. So you would say the trend of the S&P 500 since 1990 is 6.6% annualized. And now you can very easily see when are we above trend or below trend. And that can tell you when the S&P 500 is unattractively priced or attractively priced, respectively. And so we can go through that and what that means for prices as well.
And just explain, I think this graph shows you can spend a lot of time above trend and a lot of time below trend and a lot of time at trend. So help the viewer understand the durations here.
Yeah. This is not a timing tool at all. The usefulness of this is when you're working on a financial plan, or you're coming up with expected return assumptions for a pension plan, or you're looking for a starting point for portfolio construction. You're saying, over the next 10 years, what type of returns can I expect from stocks? You say, well, it's highly dependent on the price I pay today. And so what we build into here is if we are above trend. So let's take an example. Let's take right before the tech bubble burst. That is the most significant move above trend for the S&P 500, basically in history, right? So if you're above trend, stocks are expensive, and then we can very easily calculate now what would be the annualized return over the next 10 years if the S&P 500 goes from where it is above trend back down to trend. And it's pretty ugly at that point. Actually, it's forecasting negative returns over the next 10 years. Right. So not a great timing tool, very useful for constructing portfolios, right? Because you look at that chart and you say, well, this probably predicted negative returns for the S&P 500 over the next 10 years for about 3 years before the tech bubble actually burst. Right. And that's exactly right. And that's why you have to layer in things onto this, like what's your outlook for the other things that matter: liquidity, growth, inflation, recession. Those are the catalysts that can cause equities to mean revert.
Right.
Okay. So you can't just look at this in a vacuum, especially if you're trying to predict returns over a short-term time horizon. But it is a key part of our framework and our process. It is the starting point. And another thing to note is equities mean revert over time. And this is useful information. It's very easy to see how useful it is. the correlation of that trend line to the actual index is 0.86.
Right.
I mean, stocks go up and they go
They
down.
go
There's
down.
euphoria and there's panic.
Yeah.
These are facts of life.
Yeah, it allows you to take a much longer viewpoint relative to what's happening day to day.
Yes. Yes.
Okay, so let's talk about the price effect as we've laid it out here, because all equities are not created equal.
Right. Exactly. So each type of equity asset class or style we can put in this framework, this long-term mean reversion framework, to determine are they above trend or below trend. And if they come back to trend over the next 3, 5, 7, or 10 years, what type of return would you get?
Right.
So that would be the price effect. And so this chart looks pretty similar to the last chart, but you'll notice the numbers show when you are above trend, you have a negative price effect. I am taking percentage points out of future return expectations. So once again, all equities are not created equal. Everybody looks at the S&P 500 right now or US large caps, and you would easily say it's expensive. We're above trend. You should assume lower returns in the future. That is true. If you were to just broadly buy US equities, that is exactly right. But, for example, value equities, the price effect is only negative 30 basis points annualized.
Right.
Another way of saying they're basically at trend. They're not expensive. And what is that trend? That trend is about 8%. So that's pretty good. And then same thing for small caps. Small caps are only 1% basically above trend. So only a negative price effect of 1.1%. So you don't have to just accept that the market is expensive and you're going to wait in cash.
Right.
This framework works for pretty much all equity asset classes. It's extremely useful, and it's a big reason why, our starting point now is give me a really good reason outside of prices to own growth stocks.
Right.
Because when I just look at prices and valuations, it's tough.
Right.
It's really tough.
You can see that was a mistake here.
Yeah.
And now it's a good thing here.
Exactly. Yeah. Not a great timing tool.
Right.
Not a great timing tool. But as you think as a long-term portfolio construction, and more importantly, this is the starting point for our framework. First, what is the trend return for the asset class? For example, for US large caps, it's over 6%. Now, what is the price effect? How far above or below trend am I right now? And what does that mean for me?
Right.
If I'm above trend, that price effect is negative. So that immediately starts reducing my expected returns. And then what liquidity, growth, and inflation environment are we going to be in? Those can either positively or negatively impact expected returns.
Right.
And is a recession coming? Right. And you put each of those things together, these are the things that matter, the basis of our entire framework. And that will allow us to have a forward-looking return expectation and determine which asset classes are attractive or not.
Right. So when liquidity was abundant back here in these periods, growth stocks did very well.
Yes.
And now we're forecasting liquidity to tighten up considerably, as we've already seen, and growth stocks have started to do poorly. So
exactly.
That's how we use this tool. Any other insight you want to share with the viewers?
It also works for bonds in a little different way. And so that's definitely something, if anybody's interested and wants to reach out and discuss, we can do that. But basically, you look at the yield on a bond. It's a very good predictor of your future return.
Yep.
Are yields low or high? If they're high, you should expect higher returns. So we use it very similarly for the bond side.
Yeah, works for a lot of asset classes, and we embed this into our process and helps us build these portfolios and allocate between them, and really impacts our tactical decision making for our clients. So like Mike said, if you have any questions, we'd love to talk about this stuff and show you how we incorporate it into our models.